introducing Chicago Atlantic Group. Please join and welcome to the stage the co-president, the one and only Peter Sack. Let's hear it for Peter.
Hi, thank you all for having me and thanks for taking the time. I'm Peter Sack, I'm the president of Chicago Atlantic Group. We are among the largest lenders and earliest movers of lenders and providers of debt capital in the cannabis space. I've been coming to these conferences for close to 5 years now, and it's been wonderful to see the group grow and the community grow. It's a testament to the industry. And I think cannabis is really unique in terms of the community that it builds. You know, no matter where you are in the value chain, as an operator, investor, vendor, supplier, we're all facing a lot of the same regulatory complexities, consumer complexities, and changing landscape. And I think that builds a really tight-knit community where really even your toughest competitors, you can pick up the phone and call and hash out these problems. And as value-added lenders, that's core to what we do. We work to build a community amongst our borrowers, amongst our investors, and even people that aren't working with us to navigate these problems and navigate these complexities. Let's see. There we go. So Chicago Atlantic was founded in 2018. We were founded with the main mission of bringing institutional lending and non-cannabis debt facilities to the cannabis world. At the time, that was quite novel. It's still novel to a certain extent today. And over the past 4 years, we've deployed close to $1.2 billion in loans over 38 transactions. Our portfolio today is about $324 million. Our vehicle that we're discussing today is called Chicago Real Estate Finance Inc. It's a NASDAQ-listed REIT under the ticker REFI that has a portfolio size of $324 million, largely providing real estate-backed loans, both cultivations and dispensaries, to cultivators, retailers, operators across the value chain and across the country. We've made loans in almost every state legal jurisdiction across the country, and we have a pipeline of close to $1 billion of opportunities that we're navigating through now. We're among the first movers in the space. I think the challenge as a first mover is to continue to innovate and to continue to provide products that are attractive to our borrowers and to our investors. I think there's a lot of room to grow within the cannabis industry in terms of bringing new products that are excited to borrowers. I mean, we operate in a space where no one is providing working capital loans to cannabis companies effectively, very few. Very few people are partnering with banks, and we're among the first to do that. Very few people have institutional leverage facilities. We're the first to have a bank facility backing our portfolio. These are the kinds of value-added lending that we want to expand upon, is not only be a first mover, but to continue to be an innovator in this space. Our founding team members are John Mazarakis, Tony Capel, and Andreas Bodemeyer. They founded this on a wish and a prayer and built an incredible network of private investors that have sustained us both as a private fund and as a public fund. We have a diverse background that spans real estate development, credit underwriting, workouts and restructuring, as well as technical analysis and consulting. We've built an incredible board that's been supportive both in terms of building this vehicle, Chicago Atlantic Real Estate Finance, as well as our platform as a whole. And they form an integral part of our community in terms of building relationships with borrowers, building relationships throughout the community. Our portfolio has grown substantially from $72 million in Q1 of 2021 to now more than $300 million, and we expect to grow considerably over the coming months. Our weighted average portfolio yield is 17.3%. Which is an unlevered portfolio yield as of March. I think it's interesting as we look across the spectrum of borrowers, that 17.3% is made up of a varied risk, a range of risk and a range of risk-adjusted return. We're the lead lender to Verano, we're the lead lender to Vireo, lead lender to Gage, lead lender to Schwaz convertible notes. And you see a dichotomy between lower yielding lower yielding investments and low cost of capital for large publicly traded MSOs and diversified operators, and barbelled with higher yielding opportunities for single state operators, earlier stage companies. And that's the way the lending community should be. Cannabis should be a place where the lending the returns represent the risk, and large established cash flowing companies are meriting lower debt capital, and early stage riskier smaller operators are meriting more expensive capital. And that's a foundation of what we do is matching the risk to the return to our borrowers so that we can serve both our investors and the industry. We have a very diversified portfolio. Our largest position is about 13%. We're diversified across many states. Our largest state concentration is 13%, and highly diversified across cultivation and retail assets. Our real estate coverage is 1.8 times value, or about a 55% loan to value. In addition to real estate, we're also fundamental underwriters of the businesses that we're investing in. And we take as collateral the accounts receivable, equipment, licenses, pledges of equity. We are both real estate investors and fundamental cannabis investors. And when it comes down to it, ultimately all of these assets are only as valuable as the cash flows that they can generate. And that's fundamental to each of our investments. We have dedicated five underwriters across our team. If there's an operator in the audience and we haven't reached out to you, you'll probably hear from us pretty soon. Cannabis is our primary focus. This is the industry where we built ourselves, and this is the industry that we're going to continue to serve going forward. And this slide is really the secret sauce, if there's any secret sauce. We are fundamental, detailed investors modeling out our borrowers' operations from the room level. We measure the rooms, the tables, are calculating our own yield per square foot, our own cost per pound analysis on each of our investments. And that's what drives our ability to both protect the downside of our investors, but also to stretch and provide capital to great operators and to see the vision of growth for people that are looking for growth capital to build that next cultivation, to expand it to that next state, to do a merger or an acquisition. And it's only through that fundamental, detailed, ground-up analysis that we can do that. We're not operators on our own, and we don't pretend to be, but we want to know as much about our operators' cultivation as they do. We'll never get there, but we want to get as close to that as possible. When we think about collateral, we're thinking about real estate, we're thinking about cash flows, we're thinking about working capital. And most importantly, we're thinking about the quality of the management team and their experience, their ability to execute, and their ambition, because that's ultimately what it comes down to. I won't go into details of the growth of the cannabis market here. You've probably heard it a dozen times in other conversations today. But we're really excited about the opportunity to finance both real estate and, to a certain extent, non-real estate transactions across the country. Our pipeline is close to $1 billion today and growing, and we want to continue to be a lender of choice for both large established multi-state operators and private growing young operators. Our best relationships started from a $5 million loan and grew to a $300 million loan. And every new investment that we make, we're looking at it not just of what investment and product we can provide today, but also thinking about how we can fund growth amongst our borrowers 1 year down the line, 2 years down the line, 5 years down the line. As we think about the competitive landscape and what options our borrowers have for financing, there are a number of mortgage REITs similar to us. There is a limited number of BDCs, or business development companies, and sale-leasebacks are probably the most common option that borrowers are using or considering to use in conjunction with a mortgage loan such as ours. I'll tell you some of the ways we think about that choice that our borrowers have to make between real estate-backed debt or a sale-leaseback. In the case of real estate-backed debt, the duration is probably shorter. The cost of capital might be a little bit higher. But there's more flexibility to upsize the loan and grow over time. And you actually still own your assets. And most of our borrowers, their crown jewel of asset is their cultivation. That's what they've put their heart and soul in. That's what they spend every day trying to optimize. And our mortgage lending product allows that to stay owned, to stay a core asset of the business, as opposed to selling it through a sale-leaseback. I think also importantly, a sale-leaseback locks you into a cost of capital for a very long period of time. And we all hope that there's going to be liberalization in banking and lending rules. We very much look forward to it because it's going to lower our cost of capital as well and allow us to continue to provide competitive facilities to our borrowers. And the sale-leaseback can be detrimental if lending markets open up in the near future. That being said, our borrowers have to make this cost-benefit analysis every day, and we try to guide them through that process on the pros and cons of each. As I said, our portfolio today is north of $300 million, including unfunded commitments. We have a weighted average yield of close to 17%. Our pipeline of close to $1 billion today is growing quite large. We have the only senior secured bank facility of all the mortgage REITs that allows us to grow very quickly, to scale, and to provide quite competitive cost of capital. And I think most importantly, we're thinking about how we can constantly innovate and provide new products to our borrowers. And that includes building community, making introductions, providing opportunities for M&A, aiding in real estate development and site selection, aiding in construction management. And then on the financial side, we're among the first to partner with banks and with bank lenders in this space to provide credit facilities to our borrowers. And that's something that we're really excited to do. We want to be the most cooperative and helpful lender in this space, whether you're using us as a capital source or not using us as a capital source. And we're really excited for what the future is going to bring. I'd love to take any questions and talk about the market or talk about some of our investments that would be helpful. The question was 17% portfolio yield. How is that split up between current interest versus non-current interest? Speaking a little bit off the cuff, our current pay is somewhere between 10 and 12%, with the balance made up of paid in kind interest. Oftentimes, some of our earlier stage borrowers will prepay interest up front, or will provide a period of non-cash pay interest for a period of time until operations are set up and cash flows are generating. Mm-hmm. Yes. How do you build a pipeline? Question was, how do we build a pipeline? We have 5 dedicated originators that are going through the license lists in every state, building our lists of who we think are the top operators, and making phone calls. We're unique among lenders in this space in that we've been lead lender, collateral agent on nearly every transaction in our book. And we do that because we have such a presence in the industry that we're usually originating these things from the get-go. And we want to maintain that relationship so that we can grow with them to the next facility and the next facility and the next facility. And most of the loans in our book, we started talking to them a year before they did this facility, before debt capital was even on their minds. And it's through that constant touch that we build a pipeline. A lot of our lenders, they'll be talking to us, and a lot of our borrowers will hire a broker or hire a bank. And when they do choose to make that choice, it makes it really easy because we've already been talking to them for 6 months or a year. We already know the business, and we can move really fast to execute. We close most of our loans within 30 to 45 days of signing a term sheet. With very few exceptions, every term sheet we've signed, we've closed. And that dependability is really core to our relationships and the reputation that we've built. Nope.
We got one more question here, Peter. I saw a hand go up.
In our REIT, we do not take equity, and really we're we're prohibited from doing so under NASDAQ regulations. But I think one of the ways we differentiate ourselves is providing non-dilutive solutions to our borrowers.
We had a couple pre-submitted questions, so while we're already firing away a couple softballs for you, why do you focus on credit?
We focus on credit because it's an underserved part of the market. There are very few operators in the space that can write debt checks of north of $20 million. And I think that creates both an opportunity to build the best relationships in the space and the opportunity to, in the view of our investors, create the best risk reward. We seek to generate equity-like returns with credit-style downside protection, and we've certainly built that in our portfolio today, and hope to continue doing that going forward. I think the other question is, why do private investing versus public investing? And we do that because we want to do our analysis based on the most detailed information possible, and that's the core piece to what we do. We tend not to participate in large public syndicated bond deals simply because a lot of the access to information isn't as strong as we'd like. We visit every facility that we've underwritten and had boots on the ground and looked at the rooms and made sure that the measurements match what we're underwriting. And that's never going to change for us.
Peter Sack.
Thank you all.